in this week, so this would be the week of October 9th, um, what I'm thinking about is, I guess, a continuation of what I was talking about last week. Again, this is kind of just an informal, what am I as an economist thinking about this week? What is it that concerns me? What is it that interests me? Um, and I've been stuck on this theme for at least the past 2 weeks or 3 weeks, that everything that I thought was going to be the case by the end of the year is not the case. So my predictions at the beginning of the year of what the end of the year would look like have been completely wrong. And the biggest way that we can see this is if I just look at this 1 year, what have happened to bond yields over the past year. And in this case, that bond yields have gone up since January. So this would be a 10-year Treasury bond. So this would mean U.S. government debt is paying an interest rate for a 10-year bond of about 4.17%. But that in itself, yes, it's higher than it's been in the past 5 years. So that would be bad, at least in one sense, because it means that U.S. government debt and the deficit are now more expensive to fund. But the other concerning thing here is that, right, if we look at this from back in January, where we're at about right here, is that the interest rate has increased. And the problem is that everyone at the beginning of the year had been making the bet that bond yields would start to fall because the central bank would start reducing things or whatnot. And it's actually not been that case. One second. So what that means is that everyone made these big bets in January that interest rates were going to fall because the Federal Reserve was going to start trying to reduce interest rates. But if anything, that hasn't happened. The interest rate hasn't been going up. The Federal Reserve has even said most recently that interest rates are not going to fall. And the biggest problem we have right now is not only, as I was saying last week, not only do we have a situation where people aren't going to be able to borrow as much because the money to borrow is more expensive to borrow, but the bigger issue has been that investors, we're talking like big ones, like big banks, insurance companies, everything, made significant purchases of long dated bonds like this, a 10-year bond. So they bought lots of 10-year bonds back in January of 2023, let's say at an interest rate of 3.53%. Now these bonds, even though it doesn't come due for 10 years, you can sell it earlier than that in the market, just like you can sell stocks, at any point in time. There's a bond market. You can sell bonds initially when they come out, which we call the primary market. And then bonds also have a secondary market where we would resell them, before they're due. But here's the thing. Let's say I have a bond that was issued in January of 2023 at an interest rate of 3.53%. So it's going to pay 3.53% interest for 10 years. What's the value? And let's say the value of that bond was 100 cents on the dollar, meaning it was a 1-for-1, the issue price of the bond. Today, that same bond being newly issued, a new bond issued in August of 2023 pays 4.17%, which is higher. So now, what would a person pay for that bond that was paying 3.53? They're not going to pay 100 cents on the dollar because they're not getting as much interest than if they just bought a new bond today. So that means that existing bonds that haven't matured have been losing value. Now that's important. If you didn't understand what I just said, rewind the YouTube video back and listen to that again. But to repeat, newly issued bond, January of 2023, let's say paid interest of 3.53%. That same bond today is paying 4.17% higher. So as interest rates have gone up, that means that bonds issued in the past that paid less interest, like this one in January of 2023, are now worth less. We're assuming here people aren't holding it to maturity, right? So a bond for $1,000 is still going to be worth, you're still going to get $1,000 10 years from now. But the issue here is that you're not going to get that value if you try to redeem it earlier. Because no one's going to want to pay you full price for a bond that pays 3.53% when today they can get 4.17%. So here's what I read. I have no way to prove that it's the case. Bank of America, big investment bank, went all the way back to 1787. 1787. They got data all the way back to 1787. Now, we don't exactly know if the data was that accurate because, during the War of 1812, for instance, do we really know, were bonds really trading that much? But in that 236 years of market data, this year has been the worst bond market year ever in our 236 years of data. That bond prices have basically collapsed. And what it works out to be is that the market has gone down something like 50% for bond in the bond market has collapsed almost 50% this year. The bond market, no one wants bonds issued in the past anymore because they're paying such low interest rates compared to today. And you can see this here even, right? What if I bought a bond back here in July of 2020? 0.62%. Think about how much I would have to mark that bond down by when new bonds issued are paying over 4%. A lot. This right here is why those banks failed back in May or March. Silicon Valley Bank and whatnot. Why did those big banks fail back in March? They're probably doing some bad things, but for the most part, banks are forced to buy or required to buy U.S. government bonds. So they put a bunch of their money into these long-dated bonds that paid really low interest rates. And then what they found is that now the value of that asset that they bought is now not worth very much. Another bank that ran into this problem here, and I'm not saying this bank cannot fail, Bank of America cannot fail, but if we go to Bank of America in the news, I'm sure it's going to be, it's got to be a top story. So look at that. Bank of America back at the beginning of the year bought a bunch of bonds that are yielding about 2.4%. But today, again, those interest rates are between 4 and 5%. So those bonds that this bank, one of the biggest banks in the United States, holds long dated, meaning not due for a long time, low interest bonds that are not worth very much because their yield is much less than the current yield. This is exactly what I'm worried about today. And, I know that, my discussion here might, goes beyond what we're talking about in class, but I think you can see some applications as they apply to the deficit, as they apply to the debt, as they apply to U.S. capital markets, but also what it would just mean for the economy in general. Because if these big institutional players are being hurt in this kind of way, then we start to question whether they can continue to exist in that kind of fashion. So that's what I'm thinking about this week. And surprisingly, we're not talking about it a lot. The fact that I told you that the bond market has collapsed the most is one of the worst markets ever this year. Again, having collapsed 50% in value. Here's just another way to think of it. Let's just look at this. Let's just look at Vanguard. And just look at a bond fund. Fixed, let's just look at a bond ETF. This would be an exchange-traded fund for bonds. Super safe bonds that, let's just look at BND. It sounds just as good. Okay. Not risky, just bonds. Regular bonds. And let's just look at how it's done. Well, let's just look at how it's done. year to date. That these bonds have lost 1% this year, and that they've lost 3% for the year, on a 3-month basis. Again, for bonds in this case, these aren't just like long dated bonds. These are a variety of bonds over a variety of time periods, medium and long term bonds for medium and long term goals. Yes, this might not look very great, but if we look at this even over a longer period of time here, so look at that, down 15% last year, 3% down in 2021. This has been 3 years, because now we're going to have 2023 here, 3 years of bonds falling in value. Such that over the last 5 years, let's not count the 10 years, but over the last 5 years, that the bond market has been incredibly bad as an investment device. Okay.